Good morning, everyone. Today, our topic of discussion is financial statement analysis. Financial statement analysis, commonly known as ratio analysis. Now, what this ratio is all about? In simple language, ratio is a relationship between two variables, right? Suppose if I tell you that I have earned a profit of 2 crores. Now, just tell me whether it's good or bad. You won't be able to say, because you have earned a profit of 2 crore by investing how much? That is more important. How much funds you have invested and accordingly you have earned 2 crores, that is more important. Or how much amount of sales you have done in order to earn a profit of 2 crore. It means if I simply tell a financial figure, it is of less importance to you, right? You need to create a base for any financial figure, and when you create a base for any financial figure, it is known as a relative measure. So ratio is a relative measure, right? Now, suppose I tell that I have earned a profit of 2 crores by investing, say, 10 crores, right? So if I say I have earned a profit of 2 crores by investing, say, 10 crores. So another person will tell, even I have earned 2 crores, but not by investing 10 crores, by investing only 5 crore, right? So now once you calculate a ratio, when you establish a relationship between two variables, it's a relative measure. First of all, it is not an absolute measure, right? This is not an absolute measure. Like profit and loss gives me net profit, balance sheet gives me net worth, right? Balance sheet tells us analysis. Balance sheet basically it's a statement showing the list of all assets and liabilities and the shareholders fund, right? Whereas net profit tells us the profit and loss account tells us the net profit of the organization, right? So those are absolute figures disclosed by profit and loss and balance sheet. Now those absolute figures are of less importance. It is basically meaningless. So you need to create a base for it. You need to express it as a percentage of some variable. So that is relative measure, right? So once you calculate a ratio, the next target would be analysis. Ratio analysis. Now how do you analyze the ratio? Basically you need to compare the ratio with yours past year performance. So accordingly you can say whether you have grown your business or not. Yours competitor, you can compare your ratio with your competitor. Then the industry to which you belong, so you can tell your performance whether you're below average or above average. And you can also compare your performance with the economy. So a ratio is a relationship between two variables. It's a relative measure. Like profit and loss account gives you net profit, balance sheet tells you list of all assets and liabilities, net worth, current asset, current liability, total debt, total shareholder fund. So those are absolute measure, right? It is not of much importance, much relevance. So you need to create a base for it. You need to express one variable in terms of another so that you can get some meaning out of it, right? Suppose I have earned a profit of 2 crore on an investment of 20 crores. It means 10% is my return on my capital employed, right? If I invested 20 crores and I have earned 2 crores, it means 10% is my return on capital employed. So the ratio gives me some sense. It gives me some meaning, right? Further, you need to analyze these ratios. So when you need to analyze the ratio, you need to compare it with your previous year ratios, or with your competitor ratios, or with industry average, or with the economy, right? Right. So this is what a ratio is all about. Now there are different types of ratios. You have ratios related to profitability of the organization. Then you have ratios related to the liquidity part, the ratios related to your solvency part, right? There are a lot of different types of ratios you have, right? Let us go through one by one. So if I tell you type of ratios, so you have profitability ratios, then you have liquidity ratios, right? And then you have activity ratios, then you have solvency ratios. Basically this is the relationship of profit either with sales or your capital investment. Either you need to express ratios in relation to sales, or you are going to express profit in relation to investment, right? So profitability ratio is basically profit relation with sales or profit relation with investment. How much you have earned, what is your cost of production, right? Suppose if I have made a profit margin of say 30%. So by making a sale of 100 rupees, I am doing a profit of 30. It means my cost of production is 70, right? On the other hand, there might be some other organization who is having a profit margin of 60, right? So in that case, his cost of production is 40, right? Similar. So we need to understand the relationship of profit with respect to sales or with respect to investments. Then if I talk about liquidity ratios, basically we'll be talking about ability to meet short-term obligations like payment to creditors, payment for wages, payment for overheads, rents and all. So generally you need to meet your short-term obligations with current assets, either with your stock, debtor, right? You're not going to use any long-term assets for this. So ability to meet your short-term obligations with the current assets. Activity ratio means the efficiency test. Basically efficiency, how quickly you are selling your inventory, how quickly you are realizing the debtor, and how late you are paying your creditors. So basically we'll be talking about how quickly we are selling inventory, how quickly we are realizing accounts receivable, and how late we are paying accounts payable. So generally people would like to defer accounts payable and get early cash from your accounts receivable, right? So if you do this, then in that case your working capital requirement will be less, right? The quick you're selling your inventory, your working capital requirement will be less. The larger you're taking time to sell the inventory, your working capital requirement will be more. It's simply uh, basically it's larger the period for selling the inventory, right? So these are known as turnover ratios. It is also known as turnover ratios. The larger time you take to sell your inventory, the larger will be the requirement for your working capital, right? Turnover ratios. And if I talk about my solvency ratio, basically it's the ability to meet long term obligations, right? It's the ability to meet your, so there are different type of ratios which gives us different type of meaning, right? So we have profitability ratio, how much you are earned on your investments, right? What percentage of sales is your profit and what percentage of sales is your cost of production. So these things we need to focus, right? Then liquidity ratios, basically short term payments, whether you're able to meet your short term payments or not. Activity ratios, basically it is to test the efficiency, how quickly we are selling inventory, how quickly we are realizing accounts receivable, and how late we are paying accounts payable. Obviously you need to pay your accounts payable on time, but still you can delay as much as possible if the creditors are giving you some kind of credit period, right? However, you should not be uh, delaying so much so that the creditors next time they won't sell you goods on credit, right? So that thing also you need to keep in mind. And solvency means the ability to meet your long term obligations such as debentures, right? So after 3 year 4 year down the line you might have to repay back to your debenture holders. So these ratios will help you out whether you have sufficient funds to pay them off or not, right? Okay, so we will be talking about one ratios after the another. So first of all, we'll be taking up this profitability ratios, and then we'll be talking about this liquidity ratios. Okay. So first of all, let us talk about profitability ratios. Now, before talking about profitability ratio, higher the better it is. Simple. The amount of profit is not relevant. What is relevant? The percentage of profit is relevant, either with respect to investment or with respect to sales, right? So we have one this gross profit, right? That is GP by gross profit by sales into 100. But before that, let me just give you a rough income statement, right? You have your sales, then you subtract your cost of goods sold, so you get gross profit. So gross profit is basically the difference between the selling price and the purchase price, nothing else, right? Then you have your operating expenses. So this is your operating profit. In short, we call it as sometimes EBIT, right? And from this we subtract interest, so we get earning before tax. We subtract tax, so we get net income oblique net profit, right? This is how an income statement looks like. Okay, so basically gross profit ratio is the relationship between gross profit and sales. Similarly, we have operating profit ratio, so that's operating profit by sales into 100. Then we have net profit ratio. So that's net income by sales. So this is in relation to, this is profitability ratio in relation to sales. This is profitability ratio in relation to sales, right? Now let me just give you one small example, right? Suppose there is a company, there are two companies, company X and company Y. Gross profit, mm, gross profit is say 5 crore, 10 crore. Sales, let me just get one. Right now, just tell me, if you see with respect to absolute terms, right? If you see with respect to absolute terms, you can easily see that company Y, right? Company Y is having a better gross profit, right? But we are not going to see absolute measure. What we are going to see, it's the GP ratio. So that is 1 by 20 into 100. That comes to 5%. So obviously here cost of production will be 95%. And out here it is 10 by 15 to 100. That comes to 20%. So out here cost of production is 80. Now why company Y is having a lower cost of production? Because here they are enjoying larger economies of scale, right? The larger you do production, the lower will be your cost of production, right? If I am conducting an online session, online training session, whether it be 5 students, 10 students, 100 students, my cost is the same, my effort is same, right? So obviously my cost per unit will come down, cost per student will come down. So you need to understand one thing, if you are working on a high level, if you are working on an larger economies of scale, but obviously your cost of production will come down, right? So this type of analysis you need to give when you are calculating ratios, when you are establishing some kind of relationship between two variables, right? So in this case the profit margin was 5%, so cost of production will be 95, and in this case it is 20%, so cost of production will be 80, right? Okay, so this was profitability ratio in relation to sales. Now let us talk about few more profitability ratios in relation to investment. Profitability ratio in relation to investment. Right now, First of all, we'd like to calculate return on assets. So this is like your net income by average total assets into 100, right? And this is also commonly known as return on capital employed or return on investment. At times we call it as return on investments as well. ROI, ROCE and ROI, right? ROCE oblique ROI, return on assets. Now let us talk about return on equity, right? Return on equity. Now equity means the entire owner's fund. It includes the preferred stock as well as the common stock, right? So it will be net income by average shareholder equity. Right? If I tell you only the common stockholder, return on common stock. So from net income, I have to subtract preferred dividends divided by average common stockholders fund. Basically from equity I have to subtract the preferred stock, right? So automatically I get a common stock shareholder fund. So you need to understand whether they have asked for total shareholder or whether they have asked only for the common stock shareholder, right? So the word equity means the entire shareholder, full. It covers common stock, preferred stock, and this one is only common stock. So from equity we need to subtract preferred stock. Okay. So these are profitability ratios in relation to investment. Now, what we'll be doing, we'll be talking about some activity ratios and then I will give you an example, right? So now we'll be talking about activity ratios, right? Basically, it measures the efficiency of the business organization. How efficiently are they working? How efficient are they at selling? How efficient are they at collection, right? These things matters a lot. So ultimately, some connection can be established with activity and liquidity. If business organization is working efficiently, if you are able to sell your inventory quickly, if you are able to realize your data early, then in that case you will be able to meet your short term obligations in time. So as a matter of fact, you won't be able to face any cash crunch situation. You won't be facing any cash crunch situation in future. So some connection can be established for activity with respect to the liquidity, right? So let us understand it completely measures the efficiency, right? Basically we are concerned here with efficiency. So the common activity ratios are, we have accounts receivable turnover ratios, right? So basically this is net credit sales we are going to take divided by average accounts receivable divided by average accounts receivable, right? Then we have inventory turnover ratio, that is cost of goods sold by average inventory. We have cost of goods sold by average inventory. Accounts payable net credit purchases by average accounts payable, right? Now sometimes they might tell you to calculate in terms of days, so it will be number of days to collect accounts receivable. Number of days to sell inventory. So if they ask you in terms of days, then what you are going to do, 365 or whatever, 360 or 52 weeks, whatever, divided by accounts receivable turnover ratio. Suppose I am making a sale of say 1 lakh 20. If I am making a sale of 1 lakh 20 and my average accounts receivable is 10,000, right? My average accounts receivable is 10,000. Now can you just tell me what is my average receivable turnover ratio? So if nothing is mentioned, then entire sales is credit sales. So I'm making in the full year, I'm making a sale of 1 lakh 20 and my average accounts receivable is 10,000. It means I have rotated it 12 times. I have rotated it 12 times. I sold today, I realized I sold today, I realize. So like this, currently 10,000 is outstanding, and throughout the year I have made a sale of 120. It means this 10,000 I have rotated 12 times. Now what is the gap between two rotations, right? So that is number of days, right? Number of days to collect accounts receivable. So basically it is 360 roughly divided by 12, that comes to 30 days. So every debtor is paying in 30 days. If I am selling today, in 30 days I am realizing the money. Similarly, I can do it a number of days to sell inventory. So this is your again 360 or 365 whatever divided by inventory turnover ratio. Right. So basically it will give us how long you are taking to sell the inventory. Right. So if I talk about turnover ratio, it has to be high. But when I talk about in terms of days, it has to be low because you're collecting early. Same is the case with inventory turnover should be high. It means it is fast moving. But if I talk about in terms of days, it has to be low because as quickly we are selling. And in case of accounts payable, right, so you need to delay it, so it has to be low. So this is different type of interpretation that we need to do. High turnover means more quickly you are rotating. Low turnover means less quickly you are rotating, right? So these are three activity ratios which is important. There is one more activity ratio which is important, is asset turnover. That is sales by average total assets. This is sales by average total asset. Right. Now let me just give you an example so that we can understand some kind of so that we can establish some kind of relationship with activity and profitability. Yes, like I told you that activity has a deep connection with liquidity. Now activity can be connected with profitability to give you some results. Let us see what kind of results can we get. Right. Now suppose there are two companies, A and B. Now profit is 2, which is better? Suppose it is in crore. So I'm not unable to say which is better, right? There are mostly alike companies. They are both alike companies, right? So they're working in the same market, same industry product, right? Everything is same. So the profit is also same. Now, in fact, the total assets deployed by them is also same. Now, if someone asks me what is return on asset, so I'll be telling them net income by total asset. If I don't have average, then I use the closing one, right? So this is 2 by 5 into 100, that comes to 40. Here it is 2 by 5 into 100, that comes to 40. So both are same, but no, they may not be same. I need to do deep dive, right? They may not be same. I have to do deep dive. What kind of deep diving are you going to do? Basically, let me just bring sales into picture. Now our return on asset can be written like this. It's basically a mixture of profit margin with the asset turnover. Now profit margin is basically profit by sales, and asset turnover is basically sales by total asset, right? So if I do cross multiplication, then this gets cancelled, and ultimately what remains? So profit by the total asset, right? Even if the company is earning same, right? Company earning is same, company's total capital employed is same, but yet there exists some difference. So we need to do some kind of deep dive into this return on asset formula, right? Now, what amount of sale this company has done, right? So basically, company A has done a sale of 20, and B has done a sales of 10. Now I can easily say, if I see profit, if I see profit in relation to sales, if I simply calculate profit margin, so this is 2 by 20, this is 2 by 20, right? If I see profit margin, this is 10%, right? And if I do 2 by 10, this is 20%. So they're having same profit, they are giving same to their investors, but yet company B is having a better profit margin. Company B is able to produce its product at a cheaper cost, because if profit margin is 10 and out here it is 20, it means B's cost of production is 80% of sale and A's cost of production is 90% of sale, right? So see, when this topic is very important for not even for FAR, this topic is also important for audit, because auditor needs to do a lot of procedures, right? And like test of controls, substantive procedures, in that you have analytical procedures, test of details, right? So when the auditor is performing these procedures, these ratios will play a very important role. As to suppose the last year the profit margin was 30%, and suddenly the profit margin has declined to 15%. So why the profit margin has declined? So it will give auditor some points which needs to be further investigated, right? So these ratios, this financial statement analysis is not only important for FAR, but it is also very important for audit as well, right? So you need to remember this point very clearly, right? This ratio analysis, when I gave exam, frankly speaking, I got a lot of questions from these ratios, right? And in audit as well as FAR both, right? So this profit margin, if you see profit margin, see both companies having same profit, their total asset is also the same, so they are giving same return on assets, right? Same return to the investor. So investor will be indifferent, Investor will be indifferent in investing in A and B, but I need to do some kind of deep dive. So accordingly, I can make out something that it's a multiplication of the profit margin with the asset turnover. So as far as profit margin is concerned, company B is better off. Company B is better off. Now you can see one thing, even if company B is working on a low volume, company B is having a sale of 10, whereas A is having 20. So which company is on a larger economies of scale? Obviously company A. Despite A being on larger economies of scale, A is unable to capitalize on that. Its cost of production is 90%, right? So this on this part A needs to improve. On this part A needs some kind of improvement, right? Now the next ratio I'll be talking about is asset turnover. Let's talk about asset turnover, right? So out here you can see that 20 I have sold by investing 5, so 4 times, and out here I have 10 by investing 5, so that is 2 times. So now company B is unable to use its assets efficiently as compared with A. So A is able to use its assets efficiently but unable to reach the optimum cost of production. So ultimately if I multiply these two, so it will be profit margin into this. So it is giving us 10% into 4, that comes to 40, and out here it is 20% into 2, that gives me 40, right? So as far as investor is concerned, he will be indifferent, but A needs to improve more on its cost of production. A need to work on cost of production, and A need to improve its profit margin, whereas B needs to improve its asset utilization, right? So these are the areas where we can improve, right? So A has to work on cost of production and B has to work on. So for company B, its profit margin is better, and for company A, its asset utilization is better, right? So these things are very important for exam purpose, right? And accordingly they might give you 4 options, and accordingly you have to choose the best one out of it, right? I guess it's absolutely fine. So this is some kind of connection with the activity ratio and the profitability ratio, right? And I've already told you that the better the efficient you are, the less liquidity problem you will face, right? Okay. So now let us talk about some liquidity ratios. So we have spoken about profitability ratios, right? We have spoken about profitability ratios. Then we have spoken about this liquidity ratios, activity ratios, and then some kind of connection with profitability and activity, right? If you see investor point of view, it is same. Investor will be indifferent. But if I do some deep dive, then company A is having problems with its cost of production, and B is having problems with its asset utilization, right? If someone else is able to do it, why will I won't be able to do it? This is the question. कोई और कर सकता है तो मैं क्यों नहीं, right? So this thing is very clear. Now let us talk about liquidity ratios. Now basically ability to check whether I am able to meet my short-term obligations with short-term assets. So I've already told you, ability to meet short-term obligations with short-term assets. Now this is the ratio which many of you have done in your +2 level, right? So we have current ratio. Basically it is the relationship between your current assets and current liabilities, and generally it should be more than one, right? Preferable more than one. In India, the standard current ratio is 2. If you have a current ratio of 2, it symbolizes that you will be able to meet out your short-term obligations, right? So generally it has to be more than 1. Then we have quick ratio, how quickly we will be able to pay our short-term obligations. So from current asset we are going to subtract stock, and we are going to subtract this prepaid expenses, right? We can also take it as cash plus accounts receivable by current liability. Because from current asset we have subtracted stock, it means what is left? Cash and accounts receivable. Marketable securities is also cash. Marketable securities. Now, what type of questions are we going to get from this particular liquidity ratio? See, simply calculating liquidity ratio, or they won't give it, right? Now, let us do some questions on this liquidity. Suppose they will give you one situation. Cash collected from debtors. Debtor means accounts receivable. What will be its effect in current ratio? Increase, decrease, no effect, 0. Now this is something very important, right? So these type of questions are generally expected in your exam, right? From this liquidity analysis. Now, as we know that current ratio meaning is current asset by current liability. And when I talk about current asset, so we have cash, we have accounts receivable, we have stock, inventory by current liability. Now cash collected from debtor. So when I talk about cash collected, so cash increases and accounts receivable decreases, right? So suppose currently we have the 2 lakh and this is 1 lakh, right? And this cash collected is 20,000. So 20k it will increase and 20k it will decrease. So now what is happening? You can easily see that it will increase and it will decrease. Basically there will be no change in numerator. So this is 2 lakh upon 1 lakh. So 20,000 current asset will increase, and then again current asset will decrease by 20,000. So as a result, post this transaction, your numerator is not changing. Ultimately it is 2. Previously also it was 2, now also it is 2. So no effect. I've assumed that earlier it was 2. So let us assume that it was 2. Now I am showing the effect, just taking an arbitrary figure, 20,000, 10,000, whatever. So the numerator is increasing and decreasing by the same amount. So no change in numerator. Denominator is not changing by it. So whatever you had current ratio before this transaction, post this transaction also, current ratio is same. So there is no effect in current ratio with respect to this transaction, because both cash and debtor are components of current asset, right? I guess this is absolutely fine. Okay. Another, let us do few. Same option, increase, decrease, let us first take an arbitrary figure, 20,000. So now you can see that inventory will increase by 20,000. Creditors will also increase by 20,000. Current ratio is 2 lakh by 1 lakh. Now post this, what will happen? Stock is a part of current asset. So the numerator will increase by 20,000. Creditor is a part of current liability, so denominator will also increase. So this is 220 by 120. So ultimately it is coming 1.83. So it is reducing. See, the concept needs to be very clear. If you know the concept, you will be able to work it on. If you don't know the concept, you won't be able to work it on. This thing is very important. Sale of furniture, what will be its effect in current ratio? Now this is something very important. Again, all the options are same. Increase, decrease, no effect, 0. Right? So same. First of all, you need to show here what is changing. Cash is increasing by 20. There was an old furniture, so furniture will decrease by 20k. Now among these two, only cash is a part of current asset, not furniture. Furniture is non-current asset. So now current ratio is suppose 2 lakh by 1 lakh. So now only the numerator will change. Furniture is not a part of current asset. So this is 2 lakh 20 by 1 lakh. So it is 2.2. So it is increasing. Earlier it was 2, now it is increasing. Right. So this is the type of question you will get in exam. So not have to worry. Right. You will be able to do it. Quick ratio. Now again inventory increase by 20, creditor increase by 20. Now quick ratio is like current assets se we subtract inventory. So basically inventory is there in current asset. Inventory is there in current asset which we are not taking. So as a result, only cash and accounts receivable by current liability. First you take inventory in current asset, then again you subtract in what's the use. So don't take inventory, only take cash and debtor. One of the component of current asset is inventory. For calculating quick, we subtract inventory because inventory is 2 steps away. It is not quick. First we will sell and then we will realize. We have to do two activity. One selling and then again realizing. But in case of cash, it is already realized. In case of accounts receivable, it is about to realize, right? So these two are considered as liquid assets. In current asset, inventory is taken, so we are subtracting it. So basically we are not taking inventory here. So this will not be taken. So what is happening? Earlier it was 2 lakh. Suppose. So there is no change, but denominator it is 1 lakh plus creditor is changing. So this is 2 lakh by 120. How much? Assuming it to be 2 lakh cash and this is 1 lakh. It will be less than 2, right? Okay. Now there is one more liquidity ratio. Current cash debt coverage ratio. That is net cash from operating activities by average current liabilities. Means, will you be able to meet your current liability from your cash flow from operating activity? This is my question. Current ratio means current asset by current liability. It will give you a sense of security. Everything is okay. But when it comes to repayment, when you talk about repayment, will you be able to do it? So that for that you have to take cash from operating activity. See, anyway, you will be paying your current liability creditors from collection that you have done from debtor, from selling the inventory, right? So those cash realized, will it be sufficient to pay off your current liabilities? Right? So we have talked about profitability ratios, we have talked about activity ratios, we have talked about liquidity ratio. Now we'll be talking about some solvency ratios, right? So one of the ratio is debt equity, simple. Right? Now in India, the standard debt equity ratio is 2:1. It means if you have investment project of 300 crores, this is an investment opportunity, right? So basically you need to put your own funds 100 so that you can get loan funds. So this is 2:1. In UK it is 40%, right? So this is in UK. If I talk about UK, so only 120 you can get from loan funds. Own funds has to be 180. So these are different restrictions imposed by different regulations or different financial institutions, because whenever you go and apply for a loan, they will be asking you what amount of funds you are contributing, what is your own fund contribution in your project, how much skin you are putting into your own project, right? Accordingly, the bank or the financial institution will decide how much skin they want to put in. Obviously, they won't get the profit share, they are entitled to interest, but still it's about the money safety, it's about the security, right? So some is like if I talk about non-banking financial institutions, right? Companies, that is NBFCs. So they undertake a larger risk, right? So they can go for this 3:1 ratio also. Okay, you give 25% of the total funds required, I will give you 75% of the total funds required. But if I talk about nationalized, commercialized banks, right? So they won't be giving you that much amount of leverage, right? So maybe they work on 50-50. Okay, you put in 150 crores, I'll give you 150 crores. Maybe no, fine, I'll give you only 40%, remaining 60% you have to contribute. Or I'm only going to give you 30%, remaining 70% you have to contribute, right? So it depends upon the how much risk tolerance level these financial institutions and banks are ready to take, right? So this debt equity ratio is playing a very important role to determine its solvency, right? And if you breach this ratio, whatever standard is set, you need to maintain that standard, right? And if you go beyond this particular ratio, then that particular lender might force you to might force you to go for liquidation, right? Might force you to repay the money back, right? So ultimately you have to liquidate your business, right? So there are a lot of covenants or the restrictions, you can say, that can be imposed by the lender or the financial institution who is funding you, right? So it depends upon person to person, banks to banks, financial institution to institution, legislations to legislation adopted by different countries. Okay. Then we have another ratio, debt to total assets. This is debt to equity and this is debt to total funds, right? So this is total debt by total assets. So in my language, I can say it. This is shareholders' equity plus loan funds. And we have times interest earned. This is EBIT by interest expense. How many times of interest you have earned, right? We have cash debt coverage ratio. So we have net cash flow from operating activities divided by average total liabilities, not current. Out here it was, if you see carefully, current cash debt coverage ratio. So we took current liability here. But here it is cash debt coverage ratio. So I am taking total liabilities. And this is like this. This is EBIT, the umbrella. And this person is interest. And it is raining heavily. So I am protected. How many times of interest you have earned? Higher, the better it is. Think about another person, but he is bit fat. So he might get wet, right? Because his coverage is low. So this umbrella is like EBIT, and this different individual is like interest expense. Okay. So these are the different ratios. What you need to do, you need to put it in a piece of paper, all the ratios, and paste it on the wall, and you can see it. If you write these notes in a piece of paper, A4 sheet paper, and paste it on the wall, then what happens, you sometimes we get might bored up taking out the books, again opening the chapter. So nothing you have to do, it is pasted on the wall. You go home, you just spare 15-20 seconds, you can have a look. So for every chapter you can do. When I studied my when I cleared my chartered accountancy, right, I the only way I used to do, there was an steel almirah, right, and if you paste it on the wall, there are chances that paint might get disturbed, right? But if you paste it on the steel almirah, so when you take it out, it remains the same. So there was 2-3 steel almirahs at my home. So I used to take up this small paper, A4 paper, and every chapter I used to note down the notes. So again, I don't have to take out the books and all everything. So I used to paste it on the almirah, and I used to quickly have a look. So okay, fine. These are the points in this particular topic done. These are the points in this particular topic done. Right. So this is one of the smarter way of studying. Right. It might seem funny to many of them, but this is the effective way of doing it. Right. So thank you so much. Next class we'll be taking up a lot of MCQs related to this particular topic, and there is one more topic that we need to discuss is economic value added. Right. Thank you so much.